All of this stuff is collapsing. The one thing that's rising right now is gold. But again, even the gold stock investors don't realize what's going on because even they're not bearish enough. Even they don't understand. They're looking at...
Welcome to a no-holds-barred conversation with Peter Schiff. In a world where everything seems to be in a state of collapse, there's one shining star on the rise: gold. But here's the twist. Few are bearish enough to see the full picture. Join us as we unravel the complexities of these turbulent times. Peter delves into the bond market, where yields on the 30-year Treasury continue to climb, closing the week above 5%. But here's the kicker. Bond yields and the gold price are poised to rise together, and it's all fueled by one common driver: inflation. In this video, we explore the financial landscape, decode the rising gold prices, and why you might want to pay close attention to the intriguing relationship between bonds and precious metals.
Beneath the radar, nobody understands that this crisis has started. But believe me, it has. I mean, this was the way the 2008 financial crisis started. It didn't just happen when Lehman Brothers went bankrupt. I mean, by that point, everybody knew that we had a crisis. But the crisis was obvious before Lehman went under. That's the reason it went under. It didn't just go out of business, out of the dark. It wasn't just, happenstance. The reason that Lehman Brothers and Bear Stearns and Fannie and Freddie and AIG and all these companies went under was their exposure to the mortgage market. That exposure was obvious to me for years, but particularly in 2007 when the subprime market blew up. That was the point where even the village idiot should have been able to figure out what was coming. The problem was most people on Wall Street weren't even smart enough to qualify as the village idiot, so they still couldn't figure it out. They needed that proverbial, anvil or piano, whatever, to fall on their head, which is what happened in September of 2008. But even during the summer of 2008, people were oblivious to the crisis, even though it was a huge crisis. I mean, not huge compared to what we're about to experience, but relative to what anybody had experienced up until 2008, there was nothing like it, right? You had to go back to the Great Depression. Now, what we're going through now is going to be worse than the Great Depression. So, they had it easy back then. I mean, this is going to be much more difficult. But as enormous as this problem was, and it erupted right in September of 2008, Wall Street, the Federal Reserve, at least what they acknowledged, they were oblivious to this. So if you're wondering, Peter, how can we be so close to this massive crisis? In fact, how could this crisis have already started if nobody is talking about it? Well, just go back to the summer of 2008. Nobody was talking about it. Remember, I was saying it's like there's this, Category 5 hurricane right off the coast, and not a single weatherman has noticed it. Right? I was out there telling people, hey, the storm is coming, but nobody noticed it until, it was ravaging the town because, it finally made landfall. So if you want to know how it could happen, just go back. All of this stuff is collapsing. The one thing that's rising right now is gold. But again, even the gold stock investors don't realize what's going on because even they're not bearish enough. Even they don't understand. They're looking at the bond market. Yields on the 30-year Treasury were up again today. We closed the week north of 5%, 5.023% on the 30-year. And that's still scaring the gold stock investors. They don't understand that bond yields and the gold price are going to rise together because it is inflation that is driving both higher and a loss of confidence in the fiscal position of the United States. We don't have the principal. Nobody wants to buy our bonds anymore but the Fed, and we want to stop printing money. So we're just going to extend your maturity. So we'll pay you in 30 years. See you in 30 years. In the meantime, we'll keep honoring the coupon, so we'll give you 1% on your money for the next 30 years, and in 30 years, we'll pay you off, right? That's what we can tell them. Now, what's that bond going to be worth the minute we do that? 40 cents, 30 cents, right? It's a huge haircut, but that's a form of default. Now, another way we could do it is we could tell people, look, we don't have the dollar, we don't have all the money that we owe you, but we'll give you 30 cents, right? We're gonna just give everybody a haircut. But it's not just the bondholders that we have to default on. We got to tell the Social Security recipients, we promised all these benefits to get your votes. Problem is we don't have the money. And so you can't have the benefits. Sorry about that. We're going to have to cut Social Security, Medicare, Obamacare, all this. Government's going to have to tell people on government pensions, you worked many, many years for the government, and we promised you all this money when you retired, but you know what? We don't have it. So you can't get it, right? I mean, that's it, right? So the government has to kind of fess up and admit that it can't keep its promises or that it lied. And we have default. And now we have deflation. Prices come down. Asset prices, everything comes down, right, in deflation. The alternative to that is a devaluation, where we devalue the dollar. So we don't have to default. We just print money and give people that money, right? The Fed can print as much money as it wants. And it just doesn't give it any value. It can print money, but it can't assign value to that money. And the more it prints, the less value it's going to have. So we end up just printing. And so prices crash. The dollar crashes. And our creditors get their money back, but they don't get their purchasing power back. And in fact, the losses will be even bigger, right? Now, the government couldn't pay off much of the national debt if it was going to value its gold at $42 an ounce. In fact, why would it do that? The market price of gold is $2,000 an ounce, right? But if the U.S. government really wants to pay down its debt to the point where it can handle it, it could do that by repaying the debt, not by printing more money, but by paying it off in gold. But they have to revalue the price of gold. Where? 10,000, 20,000, 30,000? I don't know where the number is, but the number keeps getting higher and higher the more money we print. But we could do that because we decide what the dollar is worth, because the treasury bonds are IOUs for dollars. Well, if gold is $20,000 an ounce, it's a lot easier for us to pay down trillions of our debt with our gold when we've devalued the dollar to that degree. And we said, this is what gold is now worth. Now, of course, when that happens, the dollar's exchange rate crashes. We haven't really made gold more valuable. We've made the dollar less value. We've now officially devalued it, and we're telling our creditors, we're going to pay you back gold at $20,000, $30,000 an ounce, or whatever it is, right? And so then prices are going to have to respond. Prices are going to skyrocket for everything in line with a devalued dollar. That's why I said it's devaluation and inflation. We devalue the dollar, right? And everything goes up in price. The price of everything goes up. So if there's default, we can have deflation. If we have a devaluation, we have inflation.
Thank you for joining us in this eye-opening discussion with Peter Schiff. We hope you found this video as enlightening as we did, shedding light on the intricate dance between financial markets and the rise of gold. If you're as passionate about understanding the ever-changing financial landscape as we are, don't forget to like and subscribe for more thought-provoking conversations and expert insights. As you navigate the complex world of investments, remember the crucial link between bond yields and the ascent of gold, driven by the powerful force of inflation. Until our next conversation, take care, invest wisely, and may your financial endeavors be guided by wisdom and foresight.